Hey everyone, welcome back to Corporate Decoder, where we break down the confusing world of corporate finance. Today we're digging into Fidelity's latest shareholder report, and let's just say it's quite the deep dive into how your money is being managed. So Fidelity's Salem Street Trust has released their semi-annual shareholder report as of May 31st, 2025. This report covers the period from December 1st, 2024 to May 31st, 2024 to May 31st, 2025, and it tells us a lot about where this fund is putting its money and how it's performing. And like always, we're cutting through the jargon to get to the good stuff for you. First off, let's talk about the size of this operation. As of May 31st, 2025, the fund is managing a whopping $5,130,265,466. That's a lot of zeros, and it shows just how much trust investors place in this fund. Now, where is all that money actually invested? The report breaks down their investments by market sectors. The biggest chunk, 18%, is in financials, which isn't too surprising given the nature of dividend and income funds. Following that, real estate makes up 15.8%, and information technology comes in at 12.3%. They've also got significant investment spread across industrials, consumer staples, utilities, and healthcare, with each sitting around 8 to 9.5%. Digging a bit deeper into the investment types, the fund is heavily invested in dividend-paying equities, accounting for 50.5% of its net assets. This aligns perfectly with their strategy of focusing on dividend income. Then we see convertibles at 18.1%, REITs or real estate investment trusts at 14.5%. These are all solid income generating investment types. Geographically, the fund is heavily weighted towards the United States, with a massive 91.9% of its net assets invested here. Canada comes in second at 2.4%. Followed by the United Kingdom at 1.3%, and then smaller percentages in Taiwan, France, Ireland, and so on. This strong concentration in the US market is a key aspect of their diversification strategy. Or perhaps its main driver. Let's look at their top holdings. Procter & Gamble is number one, making up 2.6% of the fund's net assets. ExxonMobil also holds a 2.6% stake, and Coca-Cola is close behind at 2.2%. These are all big stable companies which fits the dividend and income focus. You also see names like JP Morgan Chase, Cisco Systems, and Johnson & Johnson in the top 10. Seems like they're sticking to established blue chip companies for the most part. Now let's dive into the actual financial statements. This is where we see the nitty-gritty of their performance over the 6 months leading up to May 31st, 2025. Remember, this is an unaudited report. The total investment in securities as of May 31st, 2025 is a massive $5,123,512,090. This is broken down into unaffiliated issuers, costing them about $3,456,000,000. Looking at the schedule of investments, we see that common stocks make up a significant 54.9% of the fund's holdings. This section reveals a very detailed breakdown of individual stock holdings across various countries and sectors, painting a clear picture of the fund's portfolio construction. The statement of assets and liabilities sheds light on the fund's financial position. Total assets are over $5.149 billion, while total liabilities are around $19.4 million. This gives the fund a net asset value of $5,120 million, reflecting just over $1.110 billion in total accumulated earnings and $4,090 million in paid-in capital. The statement of operations tells us about the fund's profitability for the 6 months ending May 31st, 2025. They earned $54.5 million in dividends and $12.9 million in interest, totaling $78.5 million in income. However, their expenses, mainly management fees and distribution costs, came in at almost $19.2 million. But where the story really gets interesting is in the realized and unrealized gains and losses. They saw a net realized gain of almost $84.1 million on investments from unaffiliated issuers and another $3.6 million from Fidelity Central Funds, for a total realized gain of about $87.8 million. However, the market gave back some of those gains. There was a change in net unrealized appreciation of over $243 million on unaffiliated issuer securities and another $70 million from Fidelity Central Funds. This means that while they made good money selling some investments, the value of the ones they still hold decreased significantly, leading to a total change in unrealized appreciation or depreciation of almost negative $314 million. When you put it all together, the net increase or decrease in net assets from operations for the 6 months was a negative $166.7 million. This is a pretty substantial drop, mainly driven by that unrealized depreciation. Looking at the per share data provides a more granular view. For example, Class A shares started the period with a net asset value of $18.21 and ended at $17. The total return for the period was a negative 3.6%. For Class M shares, the starting NAV was $18.20, ending at $16.99 for a total return of negative 3.6%. The expense ratios are also important to note. For Class A shares, the expenses before reductions were 0.92%, while for Class M shares, they were higher at 1.17%. These ratios reflect the cost of managing the fund, and it's good that they're transparent about it. Interestingly, the portfolio turnover rate for the fund is 38%. This means that about 38% of the fund's holdings were bought or sold during the reporting period, indicating a moderately active management strategy. Now, for my take on all of this, Fidelity's strategic dividend and income fund is clearly focused on generating income for its investors, primarily through dividend-paying stocks and other income-producing assets like REITs and preferred stock. Their heavy investment in large, stable US companies like Procter & Gamble and ExxonMobil suggests a strategy focused on stability and reliable income streams rather than high growth potential, which is good for income investors. However, the significant unrealized depreciation in their portfolio, particularly on the common stock holdings and even their investments in Fidelity Central Funds, is a concern. A drop of over $243 million in the value of their unaffiliated holdings, even if they haven't sold them yet, points to a challenging market environment for some of their investments, or perhaps some strategic missteps in managing those specific positions. This unrealized loss directly impacted their per share net asset value and overall fund performance for the period. The difference in expense ratios across the share classes, with Class Z being the lowest at 0.55% and Class C being the highest at 1.67% reported in those initial cost tables, highlights the importance of choosing the right share class for your investment. While the low expenses are always attractive, it's crucial to understand what those different classes offer in terms of services and potential sales charges. Overall, the fund is navigating a complex market. While its income-generating strategy seems to be in place with solid dividend-paying top holdings, the impact of market volatility on its unrealized gains and losses is a key risk factor to watch. For income-focused investors, this fund might still be appealing, but they should be aware of the potential for value fluctuations. Alright, that's our deep dive into Fidelity's latest shareholder report. What's your take on these numbers and what they signal for the fund's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community linked in the description below for more discussions and insights. Thanks for watching. See you next time.